In this chart, we are looking at the price movement of a market over time, shown through Japanese candlesticks. The main idea here is to understand how the trend is developing using simple concepts like higher highs, higher lows, lower highs, and lower lows. These labels help us identify when buyers or sellers are in control. When you see blue letters marked as HH, meaning higher highs, and LL, meaning higher lows, it signals an overall uptrend. This means the price is consistently moving upward, forming new peaks that are higher than the previous ones, and forming lows that also stay above the earlier lows. On the other hand, when you see red labels like LH for lower highs or LL for lower lows, it indicates a temporary pullback or small downtrend inside the bigger upward move. You can also see trend lines drawn under the candles. These lines show the general direction of the market and help traders spot areas where the price might bounce. In this chart, most of the trend lines are slanted upward, confirming the strength of the uptrend. The blue horizontal lines represent Fibonacci retracement levels. These levels are used to estimate how far the price might pull back before continuing the trend. For example, the point marked 0.618 or 61.8% is a popular support zone where buyers often step back in. The green zone on the chart shows a support area where buyers have previously entered strongly, pushing the price upward. Below that, the red zone represents a major support or danger zone where the price would show weakness if it falls too deep. Throughout the chart, trading volume is shown at the bottom, which helps confirm the strength of each move. When the price rises with strong volume, it shows confident buying. When it falls with weak volume, it often signals only a small correction. Overall, the chart tells a clear story. The market is making consistent higher highs and higher lows, showing a healthy uptrend. Small dips form lower highs and lower lows temporarily, but the overall structure remains bullish. This kind of pattern helps beginners understand how trends build over time, how support and resistance work, and how traders use tools like Fibonacci levels to anticipate the next move.
Now, let's continue exploring the next section of the chart. In this part, we can clearly see how the market reacts to important support and resistance zones. At the bottom, the green area represents a strong support zone. This is the price level where buyers have stepped in multiple times, preventing the market from falling further. Every time the price dipped into this zone, it created a higher low, meaning the market refused to break downward and instead bounced back upward. These higher lows help confirm that buyers are still in control. As the price moves upward, it encounters the red resistance zone near the top of the chart. A resistance zone is an area where sellers usually become active, slowing down or stopping the upward movement. In this case, the price touches the resistance several times, forming lower highs around the same region. This signals that sellers are trying to hold their ground. However, the trend continues forming higher lows each time the price pulls back, which shows strong upward momentum. You can also see several Fibonacci retracement levels marked on the right side of the chart. These levels, such as the 0.236, 0.50, and 0.786, help traders understand where the market might pause or reverse during a pullback. When the price pulls back toward these levels and then continues upward, it confirms the strength of the trend. As the chart progresses, the price creates a sequence of higher highs and higher lows, which is a classic sign of an uptrend. Even when temporary lower lows appear, they stay supported by trend lines and the green support zone. Eventually, the price pushes back into the resistance zone again. This is a critical moment because if price breaks above this zone with strong momentum, it could signal a continuation of the upward trend. But if it gets rejected, it might pull back to one of the Fibonacci levels below. Overall, this section of the chart shows how the market moves in waves, rising, pulling back, and rising again while respecting important support and resistance areas. This is a powerful example of market structure, teaching beginners how to read trends, identify key zones, and understand the logical flow behind price movements.
Moving into the next part of the chart, we can see the market continuing its structure from the earlier sections. At the bottom left, the price again reacts strongly from the green support zone. This support area has played an important role throughout the overall trend. Each time the price dips into this zone, buyers come back with strength, creating higher lows and pushing the market upward. This confirms that the support zone is reliable and respected by traders. As the market climbs, it forms a series of higher highs and higher lows, which is a classic sign of a stable uptrend. You can see each higher low labeled on the chart, showing how the price keeps stepping upward like stairs. The trend lines drawn underneath the price help visualize this momentum, showing the upward angle that buyers are defending. However, just like in the previous chart, the market eventually reaches the red resistance zone at the top. This area acts as a ceiling where the price struggles to break through. We can see multiple candles touching this resistance and pulling back. These reactions tell us that sellers are active in this zone, trying to prevent the market from moving higher. Despite the pushback, the price continues to create higher lows just beneath the resistance zone. This is a powerful signal. It means buyers are not giving up. They are still entering the market at gradually higher levels, squeezing the price upward. This kind of price behavior often builds pressure. When the market forms repeated higher lows right under resistance, it increases the chances of a breakout in the future. On the right side of the chart, we also see the Fibonacci retracement zones marked in blue. These levels give traders a guide to predict where the price might retrace if a pullback happens. The fact that the market stays above these deeper Fibonacci levels shows that buyers are maintaining control. Overall, this part of the chart continues to tell the same strong story. The market is trending upward, forming higher highs and higher lows, respecting support levels and testing resistance zones. Price action like this helps beginners understand the rhythm of the market, how trends build, pause, pull back, and eventually continue.
Now, let's continue with the next part of the chart. Here, the market structure becomes even clearer, showing us how trends shift from bullish to bearish and then attempt to recover again. At the bottom left, we can still see the strong support zone, which has acted as a solid foundation for previous upward moves. Every time the price reached this green zone, buyers stepped in with confidence, creating higher lows and pushing the market back up. As the price climbed, it broke through earlier resistance levels and started forming a series of higher highs and higher lows. These moves are marked with the HH and HL labels on the chart. This pattern shows a strong bullish trend, where buyers are in control, pushing the price to new highs each time. Eventually, the market reached a major resistance area, shown in the brown zone. This resistance acted as a ceiling, stopping the price from continuing upward. Once the price hit this major resistance zone, the trend shifted. Instead of making new higher highs, the market began forming lower highs and lower lows. This change in structure from higher highs to lower highs is one of the clearest signs of a trend reversal. You can see the price respecting the downward trend line, bouncing off it several times as it moves lower. The labels LH and LL highlight this downward movement. As the market moved deeper into the downtrend, it returned toward the Fibonacci retracement zone. This blue area represents a region where price often pauses or reverses. In this case, the price dipped into the zone, tested the lower boundary, and then bounced. This bounce created a new higher low, which is a hint that the bearish momentum is weakening. Toward the right side of the chart, we see the price attempting to recover. It breaks slightly above the descending trend line and forms what is labeled as the current lower low. This indicates the market is still in transition. It's trying to shift from bearish back into a bullish structure, but hasn't fully confirmed the reversal yet. Above it, the minor resistance zone shows where sellers might step in again.
Overall, this section illustrates a full cycle, a strong uptrend, a clear reversal at major resistance, a series of lower highs and lower lows, and a potential recovery forming near key support and Fibonacci levels. This helps beginners understand how the market naturally moves in phases, how trends change direction, and how important zones guide trader decisions. Now, let's move on to the next section of the chart. Here, we can again see how the market follows a natural cycle of creating higher highs, higher lows, lower highs, and lower lows. These simple structures help us understand the shift between bullish and bearish phases. In the middle left area of the chart, the market has been making higher highs and higher lows, which confirms an active uptrend. Each time the price pulls back, it forms a higher low, showing that buyers are still strong and pushing the trend upward. The market climbs steadily until it reaches the red resistance zone above. This area acts as a barrier that prevents the price from moving higher. Sellers step in and the price begins to react downward. Once the price reaches resistance, the structure changes. Instead of forming a new higher high, the price forms a lower high. This is a key signal that the uptrend is weakening. After that, we see the price fall and create a lower low, confirming the beginning of a downtrend. The labels LH and LL highlight this shift clearly. As the market continues downward, it eventually finds support in the green zone toward the lower right of the chart. This support zone plays a crucial role in stopping the decline. We then see the price bounce from this level, creating a higher low inside the support zone. This bounce suggests that sellers are losing strength and buyers are starting to return. Moving forward, the price climbs back into the yellow and green mid-range levels, but it begins approaching the red resistance zone again. This resistance zone remains an important obstacle. If the price fails to break above it, sellers may continue pushing the market downward. However, if buyers gain momentum and break through this area, the trend could shift back into a bullish phase. Overall, this part of the chart shows a full transition from an uptrend into a downtrend and then a possible recovery. The highlighted support and resistance zones, along with the consistent pattern of higher highs and lower lows, help traders understand how price reacts in different stages of the market cycle. This gives beginners a clear idea of how market structure works and how important it is to recognize these turning points in real time.